Hello, and thank you for joining us. I'm Katrina Scott, Chief Investment Officer of Mariner Wealth Advisors, and with me today is Jeff Krumpelman, our Chief Investment Strategist and Head of Equities. We are excited to present our Crystal Ball presentation for 2020. Jeff, I can honestly say it is a pleasure to co-host this call with you today regarding our review of the markets and outlook for 2020. This isn't to say I haven't enjoyed the other market discussions we have had together in years past, but the data just shapes up quite nicely this year, particularly compared to January of 2019. It's probably worth sharing a couple of stats with our audience about 2019 before we get started. The S&P 500 finished up roughly 30%, with the tech-heavy NASDAQ doing even better than that. Virtually all asset classes posted solid positive returns, including developed international equities, emerging market stocks, and gold. These asset classes didn't do quite as well as the S&P 500, but 23% returns in developed international, 19% in emerging markets, and 18% in gold is nothing to sneeze at. Even high-quality bonds posted nice returns of almost 9% per the Barclays Ag Index. Not much to dislike about those figures, Jeff. And I think the Mariner investment team takes some well-earned satisfaction in anticipating solid investment returns in 2019, when much of the world was very pessimistic this time last year, calling for economic recession and doom and gloom in U.S. equities. As you're well aware, we were contrarians, and our disciplined research took us to a very positive view that inspired us to go against the grain. I know that we're going to bring to life our 2020 outlook in specific detail in the coming minutes, Jeff, but as a quick introduction, what was it in our analysis that gave us the confidence and high conviction that 2019 would be a strong year for returns? And since we were contrarian last year, we were positive when many were negative. Are we taking a contrarian approach this year and suggesting returns will be weak in 2020 since consensus among investors in general is more positive going into this year?
Well, Katrina, you just posed two questions, and you know that I don't do anything uber quickly. So bear with me as I address them. Well, I will say up front, though, that yes, we do remain positive on the markets going into 2020, and that's after being very contrarian in prior years. We're more in consensus in that vein this year. No doubt, Katrina, as you and I have often discussed, 2019 was just a stellar year. And in the investment strategy commentary that I just penned, I borrowed a line from the famous comedian Jackie Gleason to describe investment returns last year. He used to love to say how sweet it is. And I know that dates me a little bit. He was, popular back in the late 60s and early 70s, but it is very apropos for what's occurred here. Returns were broadly outstanding last year, and it's just very rewarding that we were one of the few in the bullish camp from the start, when so many were pessimistic. And it was the data and staying glued to the facts, to answer your question, the better than trumpeted trends in the economy, earnings, credit quality, and likely better than feared outcomes on the policy front that kept us focused and positive rather than getting caught up in all the emotional negative headlines that were out there. So it's this that enabled us to embrace and execute the positive view. And if I can, I'd like to just back up and make a couple high-level comments about the decade in general, where you had a lot of pessimism throughout. It wasn't only a stellar 2019 in the midst of negativity, but also an outstanding decade that ironically was immersed in negative sentiment throughout. And in that regard, I'd like to recommend that everyone on this call who's listening in read an interesting article that appeared in the Wall Street Journal in the weekend edition of December the 29th. And the article is entitled, "For This New Year, Say No to Negativity." So it's talking about New Year's resolutions and suggesting rather than focusing on fitness and diet, maybe we just say no to negativity. It goes on to discuss a phenomenon that they've really just begun to study scientifically called negativity bias. And we have a tendency as human beings to focus so much on bad news. In fact, the article says that we need 4 good positive items that we see or compliments to offset one piece of criticism or a piece of bad news that we come into contact with. And so we tend to lose our objectivity and fail to see the good news when it's right in front of us. It talks about how the media seizes on this and how we can better control the tendency to be negative. And negativity bias is not a good thing in the equity markets because the S&P 500 is up 80% of the time. So it's fine to be negative if you're objectively so, if the data takes you there. So we really try and focus on our discipline to avoid this negativity bias. I might add that this phrase, how sweet it is, could be used to describe the returns throughout the past decade, 2010 through 2020, as we enter this new decade. Specifically, returns over this historical period from 2010 to 2020 averaged 15% per year, and it was the fourth best decade in the past 100 years. Yet investors were negative throughout this period. And if you remember, the mantra going into that decade was the new normal. And that had a negative connotation to it. It suggested that consumers would be choking on debt and in a cave, never to spend again after the housing implosion and financial debacles of 07, 08. We would be suffering from rising tax rates rather than the falling tax rates that we have experienced over the past couple of years. And we would be overregulated rather kind of a hiatus on some of the regulation that we've actually seen. And all of this was supposed to choke the economy for years to come, and stock returns were forecast to be subpar throughout that decade. And ironically, because of all this pessimism in the headlines, many investors didn't participate in the fourth best decade in 100 years. And in fact, they were selling stocks. If you look at the data, investors sold stocks and bought bonds and cash over this 10-year stretch, including in 2019 when U.S. equities were up over 30%. So it's been one of the most disrespected bull runs on record. I just bring this up as an example of, I think, one of the best examples of how you want to stay focused on the data and the facts, avoid this negativity from emotional headlines. And I'm proud to say that we did remain positive throughout this advance, and certainly in 2019, and it was based on facts and data rather than hunches and headlines. So I'll get off the philosophical soapbox, but I'm kind of glad that I brought it up because I do think, Katrina, that this is a way that we add value by helping to prevent our clients from selling at the bottom and buying at the top by staying focused on just the analysis and the facts. So let's just go to the next slide. Now we'll launch into the actual review and the questions that you posed. What happened? Why were we positive? And what do we think about going forward? And in the table in the left center, Katrina, this brings to life some of the data that you just mentioned in the introduction. S&P 500 for the full calendar year of 2019, up 31.5%. Small cap stocks trailed the large caps, but still 25.5% is pretty solid. International solid. And then you see on the right, even bonds in that Barclays U.S. Aggregate Bond Index, up 8.7%. So broadly, very positive. But I can tell you, it was not a moon rocket to prosperity throughout the year. We had a lot of fits and starts, a lot of things that caused you to check your pulse. There was a lot of fear out there at various moments. And in the beginning, we got off to a great start, the best start in decades. You see January through April, the first 4 months of last year, S&P was up over 18%, but then that was followed by the worst May that we've experienced, down over 6%, the worst May since 1955, then the best June since the 1960s. Then we kind of had a moment in late summer in that August period where folks were thinking we're going into a very bad seasonal area. We got problems on trade, and is the Fed really going to do what we hope they do and that kind of thing. But we caught an edge as good data came out, and we had a good close in the second half up, and then that created, the 30% plus return. And we think that it was really the data that took us there. Examples of what we were looking when everyone was so negative in the early goings. We were looking at the strong employment data, the healthy credit markets, improving trends in housing, strong consumer confidence. As we moved through the year, while data had softened internationally, it started to stabilize, and then you got good news on the policy front that really led to an overall positive experience, and certainly not the recession that many were calling for. We had positive economic growth, not a decline, and we had positive earnings when many folks were thinking that earnings would be highly negative. So that's why we were positive, and because of that good data, we remain positive. In terms of how we were positioned or what did well was the more cyclical growth areas of the market, such as technology, particularly semiconductors, the financials, the industrials. They led the way, not the more defensive areas like utilities and staples and healthcare. And we weren't surprised by that because of the good data. Now, in terms of our outlook and how we feel about moving forward, we continue to think the data is positive. And in fact, we had a number of very good earnings releases, or I shouldn't say earnings releases, economic releases towards the end of the year, and good news on the policy front. We had a stellar payroll report with more than 250,000 new jobs that were generated in November, and that surprised a lot of folks with positive revision to previous months, good confidence data, and then on the policy front, the Fed pivot with the third rate cut, and a phase one deal that looks to be coming through in China, and even legislation that was passed in the House on the trade agreement between the U.S., Canada, and Mexico. So all that was kind of good stuff that I think sets the stage, the polar opposite stage that we saw fourth quarter of 18 going into 19, where all that stuff was trending negative. That stuff is trending in a better or a good, very plain, as we go into the new year. The other thing I'll add to this is that negativity bias is out there, and we hear a lot of folks kind of critical of the positive returns last year, and they say, hey, it's a castle in the sky, that it was really based upon PE multiples expanding, not on earnings growth. Well, that's true last year, but PE multiples had compressed to 14 times, and people were expecting a recession. So we shouldn't be surprised to see expansion back towards that 17, 18 times kind of area when the recession didn't happen and the data continued to be positive. So we're not surprised to see that multiple expansion. It's only reasonable, not stretch levels. And the other kind of nit is that how can you have a repeat of that after a strong year like that? How can we have good returns, as an encore? And what we would tell you is we view these returns as making up for the horrible December 2018 and the negative returns that we saw in 2018. So we're not rattled by the fact that we had a strong year, and that doesn't mean that we can't have a positive follow-on by any means. I'll leave it there, I think, Katrina.
No, thanks, Jeff. I think that gives everyone kind of a good overview of what we were thinking, going into 2019 and what actually transpired. Before we go any further and start talking about 2020, it's always nice to recap the specific things we did well in the year, as well as some items that we could have done better. And so on this next slide, I think that it captures, the debit and credit sides of the ledger pretty well in terms of key items we got right or missed last year. Could you discuss these briefly?
Yeah, we always like to examine this and really have an honest conversation with ourselves. And I'm glad that the scales do seem to tip towards the positive here. And we did get, I think, some key things right. I kind of mentioned that, in the previous discussion, but this kind of puts it down in bullet point form. We did think the S&P 500 would generate 20% plus returns. And we were pretty public about that, both, on CNBC and in our crystal ball outlook that we presented this time last year. And it wasn't very popular. I remember being on CNBC in late December last year when we presented this kind of positive view, and a lot of people were shaking their heads, and right next to my mugshot was this kind of headline that said, worst December since 1931. So it was hard to be positive, but it worked out fine, and we're glad that we kind of held that conviction. We did think the cyclical growers would outperform the defensive areas, and as we just saw, that's what happened. We did think the United States would outperform international equities, and again, that was a little bit against the grain. A lot of people were saying you want to diversify more and increase your holdings internationally. We kind of held our ground on that front last year and had a tilt and have much more exposure to the United States than international. I think that's the one thing where you might see us talk about the fact that we think international equities, whether through funds with international equities or U.S. stocks that are domiciled here in the U.S. but have international exposure from a revenue standpoint, exposure through either of those vehicles, I think that international will be more competitive with U.S. returns this year and going forward for a bit. And then corporate bonds, there was a lot of talk about, perhaps we would have dislocations in the bond market, and some folks were worried about trends within corporate bonds and bonds in general. And we actually didn't see those credit fears. And in fact, spreads remain very tight, and we think credit is very healthy. So I think we got those items right. In terms of what we could have done better, sometimes you have to pay a price for being positive. We were positive early, and so the kind of positioning that we had, we really feel within our internal equity strategies that the cyclical growth companies would outperform, and it took a while for that to really occur. And so we were a little early on that, but certainly benefited from that as we moved through the year, and we think that bodes well for next year as well.
Thanks, Jeff. I know everybody's probably wanting us to get to the outlook for the equity markets, but before we, walk through the specific elements of our base case forecast for 2020 and the alternative scenarios on the return front this year, I thought you could discuss some of our key assumptions regarding the economy, earnings, and investment sentiment that underlie those anticipated results.
Sure, yeah. Regarding our economic assumptions, you can see on this slide that we believe global economic growth is stabilizing. We see that in the data internationally in Europe and Japan, and we think that, yes, it's moderating in the United States, but at stable levels. We also think that the more recent China data points to a soft landing or stabilization there, not necessarily a hard landing. And this is supported by this kind of stabilizing or healthy, solid data by stimulative monetary and fiscal policies that are actually being employed across the globe. And, if you look at China, for example, they just recently announced at the beginning of the year further rate cuts. And, we do note that they are really heavily incented at this point to work with the U.S., not only in signing this phase one deal, but perhaps to continue to negotiate on phase two and further kind of progress and trade with us. Their food inflation is more than 40%, and food is 20% of the Chinese consumers' budget. So they really can't afford to not buy our agricultural goods and see this continue, particularly as Xi Jinping goes into the 10-year anniversary in 2021, where he needs to show that the 10-year plan is kind of working. So I think that, you're seeing high incentive to continue this kind of stabilizing trend that we see kind of globally in the data. We're conservative on U.S. economic growth, and we do think it's moderating in a range of 1.5% to 2.5%. Our target is 1.5%, and that's actually more conservative. The Fed thinks it's more like 2%, and other independent economic think tanks are saying, 2 to 2.5, that kind of thing. But we think the right side of valor is to be more conservative this year, but that's certainly not recessionary, and the consumer remains quite strong. Regarding valuations and anticipated trends in PE levels and earnings and sentiment, Katrina, I think I'd highlight the following points. In terms of valuation, we look for very modest PE expansion during this kind of steady Eddie, low inflationary kind of phase. And multiples of 18 to 19 times are not out of the ordinary for a period of such low rates and positive growth. In terms of earnings expectations, we're looking for mid to high single digit earnings per share growth, and this is an acceleration from the very low single digit in 2019. But we also think that there is potential upside to these earnings expectations if the Fed remains vigilant, if trade continues to progress, if the employment trends remain strong, and CEO confidence would improve a bit through these kind of some victories on policy, then we could see a little bit of lift to multiples and to sentiment. But we're not predicting that.
So then as a quick follow-up, Jeff, how do our thoughts of this sort of backdrop impact our positioning in 2020?
I think the summary word would be balance or blend. And there are a lot of folks that are suggesting kind of extreme or more heroic positions. Oh, you ought to be all defense because we're going to have a very slow economy. And there are others who are saying, no, it's off to the races. You ought to have, just significant exposure to the very cyclical companies and industrials and forget the growth and the defense and that kind of stuff. And we say yes. We really think that 2020, you are going to see some volatility. Volatility has been very low as we go into the new year. And, even as we enter this new year, we're having some headlines here about stuff in the Mideast, some conflict in the Mideast that's a little uncomfortable. And I think you want defense on those days. And, we've also had some days and weeks where folks are feeling much more confident about what's going on in policy. And so it is the more cyclical areas that move. So we think a blend of growth and value is appropriate. For defense, we like healthcare as opposed to, staples and utilities and that kind of stuff. And we do think that international will be more competitive this year than they have been, those equities, for some time. And I did want to share a slide, the next slide, that gets a little bit at why, we're saying blend growth and value. And it just supports with price trends. If you didn't have a picture of this, you might not know whether or not that's been smart or if it makes sense or not. And you can see that both Russell 1000 growth, which is an index of large cap U.S. growth stocks, Russell 1000 values the opposite. Both of those indices are hitting new highs. So it's been broad and diversified. And I don't think you want to own one at the expense of the other. And so this is part of the reason why we really feel that blend is appropriate. And we don't always, feel that way. Sometimes it is helpful to have a more extreme view if you're uber bullish or you're uber bearish. And we're not in that camp. We think Steady Eddie calls for this kind of balance, particularly when we should see some volatility.
Great. Okay. So now we're going to move into more of kind of base case scenario. So as you like to say, this is where the rubber meets the road and where we put it on the line. So let's review our base case call for U.S. equities of 2020 and several alternative scenarios that we could envision.
Yeah, absolutely. I'm happy to do that, Katrina. And, just as a preface on this, I'll just say that we put ourselves on the line, if you will, every year when we do this. And I know that this can and will be used against us if the results are far different from what we foresee. But we don't view this as boxing ourselves in some, forecast corner, if you will. We establish our outlook and the corresponding positioning based on the facts, as I've discussed, the fundamentals, valuations, and technicals. And just as in an athletic event or a competition, if your competitors are throwing stuff at you that you didn't anticipate at the outset of the game plan, shame on the coach or the team if they don't make adjustments. And we have that same philosophy in making our investment decisions and determining positioning. If, as we go through the year, the thesis doesn't seem to be playing out in our base case, we'll adjust. We owe that to our clients and to ourselves to look at that and see if the thesis remains in place. So what we like to do is lay out the base case in green and the expected environment that we would anticipate seeing for that base case to hold true. And so some of these things that I mentioned in the previous slide, we are looking for positive GDP growth, but not robust, kind of in that 1.5% to 2.5% range. And if you get granular at all in this, we haven't talked about wage growth. We would see that staying kind of in the 3% to 3.5% zone, not getting to the 4% kind of choking inflationary, bad inflationary threshold. Payroll growth that slows, that we were pacing 200,000 new jobs a month at the end of 2019. We see that slowing, but not to a risky kind of pace, if you will, or a recessionary pace in any way. We still see job gains. Federal Reserve should stay true to its recent message that it's going to be accommodative and supportive of the strong further expansion. And 10-year Treasury is a little rise in rates, but not at a scary inflationary level, and therefore inflation that remains contained. It will tick up a bit, but not much. So that's kind of what we see. We'll monitor all this stuff to see if it's bearing out and if we need to make adjustments. So when you mix that in a soup bowl, that to us translates into a 65% probability of an S&P 500 level of 3350 at the end of the year, and that translates to a 4% price return, and when you add the 2% dividend yield, a return of 6%. So, last year we were calling for 20% type of returns. We're not as, excited going into this year, but those are very solid returns. And we do see upside. We do think that there is a 10% probability that you could get a little multiple lift, and we see consensus earnings kind of in that 178 to 180 earnings per share level for the S&P. If you hit the upper end of that range, we could see double-digit returns. And statistics do suggest that 20% plus years tend to be followed by strong years the following year as well. So there's plenty of historical support for that. Disappointing would be to us if earnings just kind of disappoint. They're not up high single digit. They're up very low single digit. I think multiples would hold in there. Folks would just be a little disappointed, and that would create kind of flat type returns next year. The pessimistic case, which is very low probability to us, we do monitor risks. The two risks that we really focus on are recession. There we would see all the economic stuff, start to slow significantly. We don't see signs of that at all. The other risk that may be underappreciated is rising inflation. And we think it will rise, but not to scary levels. But we'll watch that closely. And if we see rates and inflation accelerate, certainly swiftly, that would cause us to adjust our thinking. And that would be, I think, a tough environment for stocks where maybe you deliver on earnings, but the multiple would compress. So, all told, we're pretty positive, looking for mid-single digit to almost double-digit returns next year.
Great. So now we're going to turn to, I know that we pay a lot of attention to the fundamental valuation and technical price trend data that form the foundation of our outlook on the financial markets. We say all the time that we make fact-based decisions based on this data, not emotional decisions based on the headlines. In fact, you refer to this slide as your yoga slide that back in 2018, as well as the current moment, calms you and the equities team. Can you elaborate on this?
Yeah, Katrina, so I call this my yoga slide. If you're into music or, cooking or whatever it is, we all have those stress relievers. And for us, when we're looking at the markets, this is what does calm us. And so in answering the question, are we positive, neutral, or negative on the markets, we always go to what do we think about the fundamentals, the valuations, and the technicals. And the first thing I would ask you to note is that we're positive on the fundamentals, we're positive on the technicals, and we think valuation is reasonable. So you get a lot of pluses and a couple neutrals in here, but you don't see a bunch of negatives. And when I'm not calm on this yoga chart is if there's a bunch of negatives. So that should calm all of us right away. And we follow these just, very, very closely. And, the other thing that I would tell you, if you parse each individual kind of element within, we're looking for trend. And a couple of these, I think, you could move almost to positive. So Fed policy, while we have it as neutral, they've made it pretty clear. I think we underappreciate that they are very quick to want to cut if the economic growth slows down. But they're going to be kind of loose and let things grow if inflation starts to kind of rise a bit, and they feel like inflation should be higher. So I think they're going to be very accommodative. And if anything, some of these could be adjusted, to the positive on this front. But this is what calms us, and this is really what underlies, our work at a very high level.
So now that we're calm, let's talk about the things that we constantly monitor that concern us. Can you please discuss the current wall of worry and how we're thinking about that?
Yeah, I guess we can't get out of here without really, facing what the truth could be, right? You always want to examine, and what we read about in the headlines is in the left, and we call this the rolling wall of worry, and we constantly are monitoring this and updating what that list is. And the first thing, there are a couple key points that I tell you. The first thing is we embrace and actually cheer the fact that there is a wall and that it's relatively lengthy. The time to worry is when there is no wall. And that's when investors are euphoric, the last dollar's in, and there's no place to go but down in the market. The fact that there's a relatively high wall here says that investors remain skeptical and very respectful of risk. So that's point number one. Embrace the wall. Don't necessarily fear it. The second point is we do monitor each one of these, and we try and see if they're trending in the right or in the wrong direction. Are they manageable or not? And of these risks that are out there that we read about every day, we think virtually all of these are manageable and or trending well. So I just mentioned how the Fed, we think, is really striking the right note right now. I'm not going to steal anything about the yield curve. I think, Katrina, you'll talk about that a little later. But we certainly think that was way overblown when we heard about this so-called inversion of the yield curve. Not the fact that it can be a good indicator, but the fact that it really was inverted. Government shutdown, the legislation's passed through the House where it looks like we're getting bills through that will avoid that. Impeachment, yes, it's moving forward, but that's not an issue as we, I think, in the world can recognize that the Senate, which is Republican, favored, is the majority is Republican. He'll be acquitted. The Donald will be acquitted if it goes to the Senate. By the way, it is usually the economy, not the mere fact that articles of impeachment have come out that drive the market. The election campaign will be a circus next year. It's going to be crazy, but we don't know who the candidates are. It won't be until the spring. That will really become a clear issue as the final candidates kind of evolve. And generally, election years are good years. A little bit of volatility is going to create volatility, but generally once the individual's elected, you have a new administration, people recognize what the risks are, you got some gridlock, and the market does well. And there's a pretty long history of that. How can the market advance after more than a 30% year, really? In the S&P 500, we'll address that in a table and a chart that I think will ease your fears there. And trade is working well. You could probably add some shock events like the Mideast, North Korea, and other stuff on here. Those really are external shock events that you really can't build a portfolio for. And history shows that normally those shock events cause very temporary kind of pullbacks, followed by then the focus on fundamentals that tend not to change, and that drives the market. So we examine each one of these, but the key, and that's the third point, is we don't worry about them until it spills over into the right hand here, until it affects economic growth, employment, earnings, and interest rates, and these other factors. And these factors are healthy, stable to positive across the board. We monitor each one of these, but we feel good. Now, interest rates is something we're really going to key on this year. And we must remember that we were over 3%. We were at 3.25 in September of 18 before falling to below 1.4% on the 10-year. And we've creeped back up to 1.9. That's healthy. But we don't want to see a surge in inflation or interest rates. And we think we're far from that. But we'll watch that closely as part of our thesis for the coming year. But the wall worry to us, again, I'd say embrace it. And we don't see any of these items spilling into the data that are troublesome for 2020 as I speak. I think that's a good preface for a thesis on this next slide, Katrina, that we've called the wash, rinse, repeat cycle that we've seen throughout this bull market run. And specifically, the wash cycle is this release of negative headlines, whatever it is, the trade, the Fed, political stuff, that has tended to cause sell-offs, not just in 2018 and 19, but in 16, 15, 14, and so on. And then we get the rinse cycle, which is the release of this positive economic data, and the market rallies. And we've seen this repeat itself again and again, and we think that this will continue to play out. Wash, rinse, repeat. We would use the wash cycles of the sell-off still as buying opportunities, certainly hold our positions at this point because we don't see this as a bull market top. These are just temporary panic attacks that one can take advantage of. And we think that this is a theme that will continue in 2020.
That makes sense, Jeff. Completely hear you on all of those things, and I would expect we'll talk about that as we go through 2020 as well. Earlier, you mentioned a little bit about the yield curve. We talked about it last year, and then also, obviously, it's still on the list of potential concerns or worries. So this next slide addresses the wash, rinse, repeat pattern as it relates to one of the major worry headline scares in 2019, the supposed inversion of the yield curve. As we expressed time and time again to clients, we didn't view the inversion as a true inversion as it wasn't sustained for an adequate period of time. Further, it wasn't combined with distress in the credit markets, which we believe is the key signal of true inversion, that investors fear dislocation in bonds. This never happened. The credit markets remain very stable, which signals a healthy economy. We also find it interesting that, the bears trumpeted the so-called inversion of the yield curve as the sign of the beginning of the end, really, for U.S. equities. But now you hear crickets since various global yield curves have uninverted and are steepening in synchronized fashion. So, all in all, we take this as a very positive contrarian signal for stocks in 2020.
So, I agree with what you just said completely, Katrina. And I think also supportive of kind of this bullish view or positive view is sector leadership. And you can see it certainly in 2019, and we've gotten off to a good start in 2020. Technology led the way. 50% return in technology and semiconductors were very strong. Your high growth stocks within communication services, things like Facebook and Disney and others in that group that were up above the S&P 500. Your financials did well, and your industrials, which slightly lagged the S&P, certainly outperformed the defensives and had a very good absolute return of almost 30%. Leadership doesn't tend to be in those types of more aggressive names. These are all high quality kind of names, the ones that I mentioned, but they're aggressive names that do well when folks are somewhat confident and the economy is solid. The laggards were the more defensive areas. So these aren't, again, horrible returns, but it was utility and healthcare and energy and staples also that lagged the S&P 500. So sector leadership in the more aggressive areas is a positive sign. The next slide also shows you trends within commodities. And this is something that's really caught our eye. This doesn't tend to happen if the economy is ready to roll over. So you've seen copper, you've seen oil, you've seen commodities in general have started to firm. And, that bodes well, particularly, this is part of our thesis for improving returns internationally. You kind of needed to see it. And if you look at copper, look at that. I mean, that's what you call a bear market. That is, if you go back to the far left, that's a very steep decline in copper prices. It based, it bottomed, and it's starting to move up. And so this is also, I think, a positive signal for 2020.
Thanks, Jeff. Another thing that we often look at that we wanted to share here today is just, fund flows. And I think we've talked a lot about it being so ironic that investors have continued to sell stocks and bonds, or sell stocks and buy bonds as stock prices have rallied in 2019, much as they've really been doing since the recovery began back in 2009. So this is a contrarian bullish signal that highlights the fact that investors remain skeptical and respectful of risk, but not euphoric, which is usually what marks market tops historically. So there's still plenty of cash on the sidelines to support a future advance in stock prices. And so that's really our take on this as to why we see this as a bullish signal as well.
And I think this slide, to me, might be appreciated by folks that are watching this, because I get the question all the time, how in the world, Jeff, I know you've heard this, Katrina, how in the world can we have a follow-on year that's positive after such a robust year? And the data, actually, if you just go by history, 83% of the time, the year following a 20% plus year in the S&P 500, the market is positive, the S&P 500 is positive, and the average annualized return is 11.2%. So, again, I don't think you can just say because history did this, that it's going to repeat and all that kind of stuff. And I wouldn't be saying or suggesting, that this is helpful if the fundamentals, the valuations, and the technicals were negative, and they're not. They're positive. And I would also remind us all that it wasn't like we were into the stratosphere with that 31.5% return last year. We were down 20% intra-month in December of 2018. It was a horrible close to the year last year. And so I think the way our team views this is the strong returns in 19 in many ways made up for the very weak close to 2018 and kind of got us back to roughly where we should be. And then the data should carry us forward with earnings growth into 2020.
So then, Jeff, we've often talked about the data on this slide as well, that it supports the point that economic expansions don't die simply of old age. They die of dislocations in the economy that choke growth and cause recessions. And I know you're going to talk about kind of recession watch here on the next slide, but in signaling ends to expansions, it's the magnitude of the advance that is key, not necessarily the duration of the expansion, which we've spent a lot of time talking about last year and just even our regular commentary. And so this slide shows that the current expansion is half as robust as some of the prior ones. So it would make sense that this is a more measured, steady Eddie recovery and still has some room to run. Now, we won't argue that it is mid-cycle like some folks do, but it doesn't feel like we're in the final inning quite yet either. And the trend in the data support the fact that earnings should accelerate in 2020 after plateauing in 2019. So hopefully this paints another kind of good picture as to why we continue to be positive.
Yeah, that's exactly right. So you kind of signaled this recession scorecard, and I don't want to sound, and I don't want folks to think that you and I and the investment group is always agreeable. But, what you're saying, it just makes so much sense. And I totally agree. We do have healthy debates whenever we talk about this stuff. But this lines up pretty nicely in that if you're going to call a recession and you're going to be negative, you really do want to see signals of it. And many of these indicators that we follow on this page, they'll give you an advance warning somewhere 4 months to up to 2 years. And so you have some time, but you'd like to see, there's not like one silver bullet here. You'd like to see several of these really turn negative. In the aggregate, we have a plus 7.5 point positive reading on here versus negative readings in prior recessions, right before prior recessions. So you can see all the pluses. We monitor each one of these on an ongoing basis. And again, this is kind of like the yoga chart. If this starts to go minus, and you see a lot of red minuses here, that would be an issue for us. But it's this, not the headlines, that will take us there. Then, I think we've got a couple charts. Yeah, so this one on the dollar that you put up here, I just post this because many times the dollar can be a headwind. It has been. It's peaked, it started to roll over again and kind of stabilize here. And this is a positive for commodities, it's a positive for emerging markets. And I do think as we see stabilization in the economies overseas and accommodative monetary and fiscal policies employed, that probably the dollar is likely not to strengthen considerably and stabilize or soften further. And that actually is part of the thesis for being more interested in the international areas and making sure that we're looking at that. And the next slide kind of supports, so far as the dollar has begun to soften a bit, you can see that there was a big separation between S&P 500 and international. And the trend has started to move up for both, but the slope is steepening for price trend performance in the international markets. And so technically, these areas are looking better. Valuation has been positive. It's probably more positive than it's been at any recent juncture, but you've got technical that's moving better, and then you also have some fundamental drivers. So that's why I've mentioned international a couple times.
Thanks, Jeff. I think that's painted a really nice picture to give everyone a little bit more color in terms of what we thought going into this year or going into 2019, how things performed, and then creating a nice positioning and a why as to why we're positive as we go into 2020 as well. So now that we've covered most of the thoughts for 2020, we wanted to kind of shift attention, and we believe it's important to wrap up by keeping you focused more on the long term. First, focusing on the importance of diversification. As you can see on this slide here, no asset classes dominate forever, yet we do express our convictions by adjusting weights when we feel appropriate and value added. Jeff did mention a few times regarding international as an example, and whether that might be through exposure of international equities directly or stocks with significant revenue from international markets. And while diversification is a key component of the portfolio management, it's also important to stay focused on the long term, really. And that's by staying invested and staying focused on your individual long-term objectives as a client. And as you can see here, corrections are a normal part of even positive years. You see many years in here where we've got pretty significant intra-year declines, yet the calendar year returns were positive. So there's plenty of headline wall of worry lists that we talked about earlier that could, cause temporary setbacks in 2020. And so we do expect them. But we always like to point people back to here so we can really keep you focused on the long term. And given our current view of where we are today, when that time comes and we do have some intra-year declines, we would continue to hold positions and see such pullbacks as buying opportunities. So with that, we conclude our 2020 crystal ball. Thank you for listening, and we hope that this has been helpful for you. We appreciate the privilege to serve you and wish you a peaceful and prosperous 2020. We're looking forward to reconvening later this year when we'll do a mid-year update for you in early July. Thanks.